When you apply for an apartment or a loan with no credit history, you often face more resistance than someone with a poor history. Because you haven't used credit before, there is simply no record of your behavior for a landlord or lender to review. To a lender, a blank slate represents unquantifiable risk. Without data to evaluate, the most common response from an automated system is an immediate denial. This is a thin file. It is not a reflection of your character or your income, but it actively prevents you from qualifying for basic necessities like housing and transportation. Moving from a thin file to an established profile follows a standard set of steps. Because credit scoring is based on specific data inputs, you can generate a score by providing those inputs yourself. The objective is to move from no file to a score of 700 or higher. Following this path, that transition typically occurs within 12 to 18 months. A zero score is a temporary starting point. You can move past it by systematically introducing the data the bureaus are looking for. The most accessible entry point for building history is the secured credit card. Unlike a traditional card, a secured card requires you to provide the bank with collateral before they issue the line of credit. You provide a deposit, which is held in a restricted account, and becomes your spending limit. To build a strong score, manage your utilization by keeping your reported balance below 10%. On a $300 limit, spend no more than $30 each month. The second requirement is to pay the statement in full every single month. This ensures you are never charged interest while still building a record of on-time payments. After 6 to 12 months of this consistent behavior, most credit card issuers will officially graduate the account. They return your original deposit and transition you to a standard unsecured credit card. By managing this one account correctly, you provide the bureaus with the consistent payment data they need to generate your first real credit score. While a secured card is the primary engine, you can layer on other account types to increase the amount of data in your file. A credit builder loan is one such option. You make monthly payments into a locked savings account, and the lender reports those payments to the bureaus. At the end of the term, you receive the saved funds back. You can also look at the authorized user method. This involves being added to the credit card account of a family member who has a long history of on-time payments. Because their history on that specific account is shared with your report, you benefit from their established habits without needing to use the card yourself. Beyond new accounts, you can use supplements to get credit for bills you already pay, like your monthly rent, your electric bill, or water utilities. Third-party services can link to your bank account and report this history to the credit bureaus. This adds positive indicators to your file without requiring you to take on new debt. The secured card provides the foundation, while these accelerators and supplements provide the additional data points needed to reach a higher score more quickly. Your credit history is built slowly, month by month. It is important to have realistic expectations for how long the algorithm takes to respond to new data. In months 1 through 3, you open the account and wait for bureaus to update your record. By month 6, your first score appears, usually around 600. At 1 year, consistent payments push your score towards 700. By month 18, 740 is achievable. This timeline is a direct result of how the scoring models are designed. Consistency over time is the only way to prove you are a low-risk borrower. To keep your score on this trajectory, you must avoid several common mistakes. First, do not apply for multiple credit cards at the same time. Each application triggers a hard inquiry on your report. Too many inquiries in a short period suggests to lenders that you may be in financial trouble, which results in a score deduction. Second, do not close your accounts once they are established. The age of your oldest account is a factor in your score. Keeping your first card open, even if you rarely use it, helps maintain the length of your credit history. Third, ignore any advice that suggests carrying a monthly balance is necessary to build credit. You do not need to pay interest to build a score. Paying your balance in full every month provides the same positive data to the bureaus as carrying a balance, but it saves you the 25% interest charges. Avoiding these errors ensures that your score continues to rise steadily toward that 700+ goal. The blueprint is straightforward. Use one secured card, keep the balance low, and pay it off every month. You can monitor your progress at annualcreditreport.com. This is the official site where you can review your reports from all 3 bureaus for free. Reaching a 700 score marks the point where credit moves from being a barrier to being a financial advantage. At this level, you gain access to significantly lower interest rates on car loans, high-quality apartment approvals, and credit cards that offer cashback rewards and travel bonuses. To see a more detailed breakdown of exactly how these behaviors are weighted by the algorithm, you should study the 5 specific FICO factors. Building credit is a process of providing the right data over time. By following these steps, you take direct control of your financial profile.